So we often get asked as investment advisors, is it better to be investing for growth or is it better to be investing for income, value? And the answer is actually both. If you look at the last 10 years of investing, probably how your grandparents invested hasn't fared as well. For example, the iShares S&P 500 Value Total Return ETF over the last decade is up 174%. That sounds great, even on an annualized basis, including COVID drop and 2022 when interest rates are rising. If you look at the S&P 500 though, it was up 268% over that same time period, with growth stocks being 340% over the last 10 years. So really, when you're building a portfolio, you do want to focus out 10 years. It doesn't mean that growth stocks will continue to outpace value stocks necessarily, but the case is really being made for, especially with tech sector, all the things that are happening in that space and how every year new technology is just getting 400 times almost what it was the year prior in some sectors. If you come back to like a three-year outlook or 3-year look back, in that 3-year period, it's all pretty even. The S&P 500 was up 36%, with growth being up 32%, value up 35%. This allows for people to probably have a little bit of false sense of security, but in value side. But understand that value stocks actually did pretty well in 2022 when growth stocks were stumbling. So growth, typically you have more volatility. With value, you should have more consistent higher dividends. And then S&P 500 has a slight growth tilt to it, but you get a mixture of both. You have the growth stocks and you have the value stocks that are built in. Over the last year, we have the S&P 500 up 30% as of today, with growth stocks being up 42%, and then value stocks, your dividend payers, up 16%. So as you build out a retirement portfolio, what I like to tell people is focus on your immediate needs. So build a cash bucket that goes out 2 to 5 years. That you have enough in really short-term investments or money markets. Right now, you can get a money market yielding 4.25%, 4.5%. That's where your short-term needs are. You never want to have to sell stock when it's down. Then you would add bonds to a portfolio. Typically, you do 40% of the portfolio in bonds, and then the final 60% would be built using large cap mostly. Stocks like the S&P 500. If you want to tilt a little bit toward growth, you can add a growth fund to it or add a technology fund to it. But really the idea that you're going to buy dividend-paying stocks and you're going to sit there and hold them long-term, you're walking away from a very, very large, potentially large rate of return overall. So in modern portfolio construction, where we're using that growth over time, we sell off those gains, we buy back the rest of the portfolio or replenish your cash, where probably 20, 30 years ago, you'd build a portfolio that had good paying dividend stocks and you would take those dividends and replenish your cash with them. It's just, things are very different in building a portfolio in 2024, 2025 versus what you would have done 20 years ago. Thanks for watching.